Okay, folks, so I have some critical data that I need to walk you through regarding the dire situation that we are currently in, and you're going to want to see this. We then need to talk about the further dumping that the Fed is going to do onto the market, and what that's going to mean for asset valuations, the economy, and where we're going to be heading in the next couple of quarters. I also want to go through the absurdity of the Fed's current projections and why I believe they're going to end up being wrong. The Fed being wrong? No, Charlie, that doesn't make any sense. What are you talking about? You smoking something? This video is going to give you a no BS, detailed breakdown on what is going on right now in reality and cut out all of the fat, fear, and dysphoria and actually present you with raw data and hopefully help you come to your own conclusion. Also, quick plug, we just started yesterday our 4th of July sale on ZipTrader U. For the first time ever, if you type in coupon code America50, you will get 50% off lifetime access to our program. I'm confident that if you find value here on the channel in our daily videos, then you'll also find a lot of value in our step-by-step lessons, private chat, daily morning briefings, as well as all of our other resources in the program. Link below to learn more, but coupon code expires July 4th at midnight. Okay, so I want to start you with some pretty excruciating data here. Here's the data on what has happened to us thus far. So according to data analytics from the Daily Shot and BC Alpha Research, the scale of wealth destruction, as you can see here in US stocks and bonds, is quite frankly disorientating. The previous record was 2020, which at the time was considered a once-in-a-generation drop, right? It was said at the time that after the pandemic ends, we will never again, or at least not for a very, very long time, see the scale of abrupt and peak-to-trough wealth destruction that we saw then, because you literally shut down the entire economy. Analysts at that time were like, okay, well, this is really, really bad to see this kind of consecutive wealth destruction, but at least this is the worst-case scenario. You would have to have some sort of apocalypse scenario to see this happen again. Well, guess what? Here we are, not even 2 years later, and guess what? We've beat that, and we're now down $15.5 trillion. If you divide the losses equally amongst the American population, they come out to about 47,000 in losses per person. Obviously, these stats are just for comparison purposes. Wealth is not distributed like this. And here's another one that's even easier to comprehend. How much money is 15.5 trillion relative to GDP that we produce in a year here in the United States? Well, that's 60% of US GDP. And we're barely halfway through the year. Wealth is getting destroyed faster than we can produce it. And guess what? The Fed has barely started tightening. Imagine what happens when the Fed actually starts taking more aggressive action. And imagine the impact that this level of wealth destruction is going to have on consumption behavior, on investing behavior. If you're somebody who's already lost your wealth or think you're going to lose your wealth, guess what? You're going to be a lot more protective over what's left, which makes everything a lot worse and makes it so that things aren't going to be circulating as much in the economy, which is going to be very, very detrimental to asset prices and very detrimental to companies, but probably isn't going to bring down inflation in terms of actually things that we need inflation down on, like food and gas and overall energy. But anyways, the point is when things get rough, people get more protective over what's left, right? And this is what the Fed is trying to do. This is all by design. You look at the S&P 600 forward PEs, which actually have had a lot of their earnings downgraded rapidly alongside their price, which means that forward earnings here are probably a lot more accurate or at least realistic as compared to bigger companies who still think they're going to have massive growth year over year. And even though the earnings side of this equation has been downgraded along with the price side, well, they're still pretty damn cheap. We are at levels that you haven't seen since 2008. And these aren't like small caps that aren't profitable and are burning cash. These are small caps that are profitable. It's almost like the market is secretly telling us, hey, wait a second. We think the upcoming macro environment is going to be so bad that only the biggest and best and most well-capitalized companies in the world are going to be able to survive. This totally reminds me of a more widespread version of what we saw in 2020 in the restaurant segment. You saw a lot of mom and pop small business restaurants completely go underwater very, very quickly and not be able to pivot to shutdowns, to heightened requirements, to all of these different mandates. And so what happened is a lot of them went out of business, and all these big chains that had tons of money behind them, huge brand names, and were trusted on a wide spread because they had corporate COVID policies that they enforced everywhere. Well, they basically consolidated all the market share from all these small mom and pop restaurants, and killed them during the pandemic, and then afterwards bounced so much faster and made record profits. And I think you're starting to see the market trying to price in a similar dynamic for the future. A world where all of a sudden you don't have small businesses anymore, you don't have medium-sized businesses anymore, you just have the biggest of the big, and those are the only ones that can survive. Now, as you know, I'm a believer in small to medium-sized business. I think they're some of the most important opportunities in our country in terms of economic development and in terms of capital growth. But you do have to understand why they're getting priced so low, and you do want to make sure that you're buying companies that actually have the capital and the overall economic health in terms of how much debt they have, how they're controlling their expenses, and so forth, so that they can actually make it through a prolonged recession. But the point is, the market right now is trying to price in a complete obliteration of small to medium-sized firms. And it's also pricing in a pretty big obliteration to bigger-sized ones, but it doesn't think they're going to go out of business. You think about retail right now, retail is dipping to levels that we only see in really, really bad economic conditions. If you're a big retail store with tons of marketing, brand recognition, and the ability to get your customers seeing your products in literally every mall or every website, and you're seeing a decrease in sales, well, what about your small mom and pop stores? They're going to be doing much, much worse. And you're seeing this play out everywhere in terms of fear in this market. But go ahead and take a look at global profit expectations. This chart showcases the net percent of global fund managers that believe global profits will improve. They are now at the lowest point since the collapse of Lehman in September 2008. I understand 100% that the official response from a lot of government officials right now is still, oh, fears of the economy crashing are overblown. At worst, we have maybe a slight chance of a recession. There's a lot of people that are like, oh, we can avoid a recession with good policy making, and then on the same breath, go and do the same thing they've been doing over the last couple of quarters and act like something else is going to come as a result. But again, you look at a data set like this and you have to be thinking, wait, things are this bad before the Fed's real wrath has even been bestowed upon the economy? This bad before we've even done anything to actually see results in inflation? And look, in any market condition, you're going to be able to find one data set that suggests that we're in a dire situation. But at a certain point, you pull up dire data set after dire data set after dire data set, and you have to realize that something's up. Something's fishy. If it looks like a duck and it quacks like a duck, hey, it's a horse. Meanwhile, Google Trends show that searches for the term recession are at levels we've only seen a few times in the last 20 years. Although interestingly enough, I did hear from unconfirmed reports that search history and search trends at the White House and at the Fed are going up for certain key phrases like how to hide a recession or how to fake a soft landing. I don't know why that would be. But seriously, think about that $15.5 trillion number for a second. We've shown earlier versions of this number back when it was at $9 trillion, but $15.5 trillion of wealth destruction currently. Just for context on how much that is relative to how much we spent on COVID, COVIDmoneytracker.org says we spent around $6 trillion on COVID response via administrative and legislative actions and used $4.7 trillion via Federal Reserve actions. And the current Fed balance sheet is around $8.9 trillion. So where has all that spending gone? Well, the totality of all that COVID spending or intervention has gone into the households of American consumers, gone into businesses, boosted demand everywhere, boosted profits, boosted and strengthened the financial system, and bidded up asset prices and prices of pretty much everything. And now that the money has moved through the system, we're starting to realize, hey, wait a second. That money never existed in the first place. It turns out that you can't just create money when you don't have value to back it up, when you don't have goods and services being produced in the economy to back it up. Now, I'm not somebody who's against government programs to help people out in a time of need or to help small businesses out, but I'm really against the suggestion that these things are free and don't have consequences, and that we as an entire population aren't going to have to pay for them down the road. If you're going to pass a big, expensive social program, it's going to have to be paid for by either taxes, debt, or more endless devaluing of our currency. Now, the government, I gotta say, they're pretty crafty and efficient when it actually comes down to hiding how much they're printing and how much of the currency is actually getting devalued. As I've shown proof of in previous videos, the inflation rate they look at is very much curved in their favor. That way, when you get massive deficits, it's a lot easier to just print money out of thin air and then excuse away the inflation. And we've been doing that for decades. But when everything is said and done and the money has fully moved through the system, well, all of a sudden it's like, hey, wait a second, that money never existed and we have to all pay for it. Unfortunately, nothing is free in this world. Well, actually, some things are free. For example, if you want to get up to 10 free stocks plus 1 share of Lucid with Moomoo when you sign up down below using our link, valued all the way up to a combined $2,500, Well, that's pretty damn free, and all you got to do is try out their app. Now, if you want, you can go and get your free stocks and then cash out completely and go to a different app. But I think you're going to want to stick around because it's a pretty cool app, and they're giving you a bribe with one of the best promos in the industry to check them out. But anyways, if I was going to sum up the situation we are in 12-month Treasury bond yield language, well, a lot of people look at this period of time as what pumped the market, asset prices, and the economy massively. But then when asked what's going to happen when rates go the other way, just as fast, like they have, well, a lot of folks still drag their feet. A lot of folks are not seeing the inevitable conclusion of this. And you look at this chart of Fed liquidity injection that has been spreading around social media from cross-border capital, you could see that as the Fed guides and supports the market heavily by injecting net liquidity, the S&P 500 rallies, and then at the pivotal FOMC meeting on December 15th, 2021, where the Fed drops transitory from the inflation narrative and the CPI really starts taking off, well, all of a sudden the market peaks out shortly after that at the beginning of 2022 and starts tanking alongside net liquidity injections from the Fed. Now, there are several big conclusions from this. Number one is that injecting liquidity obviously helps support financial systems, creates a bouncing board for the stock market because it also discourages bond investing, as the more you buy up bonds, the less they yield, and the more it is necessary to buy something like a stock in order to get returns. Second conclusion is that the minute that markets realize that the Fed could no longer be on its side because of inflation and the spiraling of inflation out of control, well, all of a sudden they started self-tanking in order to factor in the coming rate hike trajectory and, of course, the further decreasing of liquidity, making stocks actually a less competitive returning environment versus something like a bond. And you go back to the Fed's balance sheet, they have $8.9 trillion or so right now. Before the pandemic, it was at about $4.3 trillion. So let's say you evaporate the difference and you raise interest rates on the trajectory that is expected. What does that look like? Well, as of the latest projection released last week, they are expecting at median to raise rates into 2023 and then start cutting as we head into 2024. They think that this current policy trajectory is going to get PCE inflation down meaningfully through 2022 and into 2023. And a branch within the central bank system, the New York Fed, has a model that assigns an 80% probability of a hard landing even with this trajectory. So think about this. The Fed right now thinks it's going to be able to get inflation down meaningfully, as you can see here, and consistently throughout the second half of the year into 2023. It was wrong in the past at the sheer acknowledgement that there would be high inflation as late as mid-2022, which we are now in, and now it's trying to convince us that it's going to be able to obliterate that same inflation that it didn't even recognize as going to exist. And inflation that it had suggested would be peaking out just about a meeting or two ago, and still thinks in this best case scenario that there's an 80% probability of a hard landing here. At least one of their banks does. So basically, if everything goes to plan and things are magical, well, it still doesn't look too great. Then you think about what happens if the Fed can't get inflation down, and that's certainly in the realm of possibility, right? That the Fed can't get inflation down on its own. We've talked about this in depth, but most of the aggressive pricing pressures that are very, very painful are in that energy segment and in the extension of food segments, both of which we have a massive supply shortage that won't be solved by raising rates and how much it costs to borrow money. For example, if there's a food shortage because it's impossible to grow food because you need fertilizer for that, and fertilizer is in shortage because you need natural gas and other commodities to make, well, it doesn't matter if you raise rates to 2%, to 5%, or 50%. You're still not solving for the supply issue. So what happens if we try to solve pricing pressures by completely destroying and nuking demand, with the Fed going and dropping the A-bomb on it, while also not solving for supply in crucial areas like energy and food? Well, what happens? Well, all of a sudden you go from a situation that we're in right now, where you have low unemployment and high prices, to a situation where you have high unemployment and high prices. You induce a recession at the same point in time where you can't get commodity prices down. The Fed does not increase the supply of things, it only reduces the amount of demand. And when it comes down to food and energy, there's very little the Fed can do to reduce demand other than completely nuke the economy to the extent that people don't need energy anymore because people aren't buying goods and services that need to be transported or manufactured or created within the system. When you get into a situation where you have high unemployment, a recession, and high prices, you're in a much, much worse situation than you're in right now. Now, I do want to finish this video off with a conversation on what could cause the Fed to reverse course. So here's a fascinating study from Bank of America global researchers who found and asked global fund managers a simple question. They asked, what do you think is the most likely reason for the Fed to pause or pivot in 2022? The number one reason by far as of June 22nd was US inflation on the PCE dropping below 4%. Last report we had on this was at 6.3%. The next release of the PCE is on June 30th, by the way, so it's pretty close by if you are looking for different catalysts to be aware of. But then you also have US initial unemployment claims rising above 300K as the second reason. They are currently around 229,000, which is the highest level since January and not necessarily a crazy amount far from 300,000. On the current trajectory, we could certainly hit 300,000 by fall. And then you also have the S&P 500 dropping below 3,500, currently at 3782. The Fed is first and foremost concerned with inflation, the stability of prices, and unemployment. But it is interesting that they put the S&P 500 here, kind of admitting that, hey, wait a second, the Fed does look at how people's, for example, 401ks are performing and how the stability of pension funds in the overall economy are doing, because those could create some bigger problems. Their official mandate isn't to look at the stock market, but supporting financial markets and making sure they're conducive is certainly an auxiliary goal. And then, of course, you have high yield bond spreads back above 500 basis points, and then oil prices below 90 a barrel. Oil right now is at 104. I made a video a couple days ago that I researched a lot for and was very, very in-depth, where I presented 5 catalysts that would mark the end of this crash. And energy being the main driver, because energy drives food prices to a huge extent and drives the cost of fertilizer and the availability of fertilizer, and thus the ability to grow food, and also, of course, the ability to transport food, and so on and so forth. But I think the big thing to realize right now, and the big point of this video, is, hey, wait a second, the Fed is going to do everything they can to nuke demand, but we need to solve for supply and energy. We need to boost production, whether that's here or in Europe or in the Middle East or South America. Something needs to be done to force more production. Once there's more supply, all of a sudden more supply can be built in other segments like food. And once there's more supply there, prices can start stagnating and then going down. Until then, the Fed is basically on its own. And the analogy that I would give is, yes, the Fed can, in a sense, indirectly solve the problem, which is high energy prices. It can nuke economic activity so much that you no longer need to transport goods and services or manufacture goods and services, and thus the demand for energy goes down. But that's the equivalent of a patient who's on a successful regimen of medicine, going to the doctor and saying, okay, well, I need some more medicine to live. And the doctor's like, okay, well, we don't want to produce any more medicine because there's a shortage, so we're just going to have you go ahead and die. Sure, that is certainly one way to solve for the supply shortage, but it's much more productive to actually create more medicine so that we can just keep the patient alive and make it so that there's as little ramifications as possible for everyday Americans and people around the globe. And this is a problem that is happening pretty much everywhere. Supply shortages everywhere, and it's all interconnected. We need production, production, production. Anyways, that caps off the video. Hope you have a good one. Make sure to get your 10 free stocks with Moomoo down below, plus a share of Lucid if you want to get 50% off ZipTrader U. Coupon code America50. Have a good one, folks. Make sure to hit that subscribe button, and see you in the next one.